To the Benzino podcast where we're calling a spade a spade. Great to be here with you guys today. The Caitlin Clark stimulus package just got approved by Congress today. It's fitting that last time a new CBA deal was reached, it was right before COVID-19, and all it takes is for a CC stimulus check to finally kick in, and now all these players are getting a cut. So salute to all of you, all the Caitlin Clark fans, the Caitlin Clark supporters.
When you step back and examine all these elements collectively, revenue sharing activation, increased attendance, stronger media numbers, and explosive licensing growth, the larger picture comes into focus. The league isn't just experiencing a good year, it's undergoing a structural shift in its economic trajectory. Moments like this often become reference points historians look back on as turning points, the season when momentum finally reached critical mass. Financial milestones in sports rarely happen in isolation. They usually result from years of groundwork, investment in player development, marketing initiatives, broadcast partnerships, and grassroots fan outreach. Once those foundations are in place, a catalyst can accelerate everything. In 2025, multiple indicators suggest that acceleration occurred. The payout to players serves as visible proof because it translates abstract growth into concrete dollars. From a negotiation standpoint, such proof carries influence. Labor discussions revolve around leverage, and leverage often comes from data. Players entering future bargaining sessions can point to real revenue-sharing distributions as evidence that the league's financial capacity has expanded. Owners, meanwhile, can highlight growth metrics to attract sponsors and investors. Both sides gain something from demonstrable success. There's also a cultural dimension. When a league crosses a financial threshold for the first time, it can alter public perception. Casual fans who once viewed it as niche may start seeing it as mainstream. Media outlets that previously offered limited coverage may increase their attention. That visibility can create a feedback loop. More exposure leads to more interest, which leads to more revenue, which leads to more investment, and the cycle continues. Importantly, milestones like this don't guarantee permanent success. Sustaining growth requires strategic planning, consistent competition quality, and continued fan engagement. But reaching the threshold proves that sustainability is possible. It shows that the league can generate surplus value under the right conditions. For longtime observers, the significance lies not only in the money distributed but in what that distribution represents. After nearly 3 decades of gradual progress, the system designed to reward collective prosperity has finally been activated. That moment signals that the league has moved from potential to proof, from projections about what could happen to evidence of what already has. And in professional sports economics, proof is the currency that matters most.
WNBA made enough money for revenue sharing before. Let's just give them a round of applause. Let's just give them a round of applause. Pop some champagne. Here, a toast to you, the WNBA.
To fully appreciate why this milestone matters, you have to rewind to the origin of the current labor framework. The league's existing collective bargaining agreement was finalized in January 2020, literally weeks before the global COVID-19 pandemic disrupted sports schedules, attendance patterns, and advertising markets worldwide. That agreement included a forward-looking revenue-sharing formula built on financial projections from 2019, with targets designed to rise by roughly 20% each year. On paper, that growth curve looked ambitious but achievable if the league continued expanding steadily. Then reality intervened. The pandemic drastically reduced attendance opportunities in 2020 and 2021, limiting ticket income and in-arena spending. Corporate partnerships paused or scaled back. Broadcast conditions shifted. As a result, the revenue targets embedded in the agreement began to look less like milestones and more like distant mathematical impossibilities. By 2022, some insiders privately admitted they doubted the thresholds would be met at all during the life of the deal. No revenue sharing was triggered that season. None followed in 2023. None in 2024 either. Each year that passed without activation reinforced the belief that the clause might remain dormant. Those circumstances make what happened next feel almost cinematic. After seasons of falling short, the league suddenly surged past the required benchmark. Analysts who once called the targets unrealistic found themselves recalculating projections. The shift wasn't gradual, it was abrupt enough to spark debate about what variable had changed so dramatically between 2024 and 2025. The quality of play had already been high. Coaching standards were strong. Talent depth was undeniable. Yet none of those factors alone had pushed revenue over the line before. The answer many observers point to is timing combined with star power. The arrival of a high-profile rookie class, led by Clark, coincided with unprecedented mainstream curiosity. Media outlets that previously offered limited coverage began dedicating prime segments to league storylines. social platforms amplified highlights to millions of new viewers. Suddenly, games weren't just sporting events, they were trending topics. That spike in visibility translated into real financial movement, which ultimately allowed the league to accomplish what had seemed unreachable only a year earlier. From a labor relations standpoint, this shift carries weight. Revenue-sharing activation strengthens the player's negotiating position heading into future contract discussions because it demonstrates that the economic model can produce surplus value. Instead of arguing hypothetically about potential growth, players can now point to an actual payout as proof that the system works when revenues climb high enough. In labor economics, tangible evidence often speaks louder than projections.
Right here. The league notified player leadership earlier this month that they hit the benchmark. So the league notified the players union. The players union submitted their proposal shortly after. Within 10 minutes, the league said that proposal's preposterous and submitted their own. So this information, though it's new to us, the players, the owners, they know about this.
Another financial development deepens the sense that the league has entered a new economic era, licensing revenue. This category includes income generated from officially branded merchandise such as jerseys, trading cards, video game likeness rights, apparel, and other products bearing union-licensed imagery. When analysts compared recent payouts to those from earlier periods, the difference was dramatic. Between 2016 and 2019, total licensing distributions reportedly amounted to about $280,000 across 4 years. The maximum annual payout for an individual player during that stretch hovered around $1,600. Viewed in isolation, those earlier numbers highlight how modest merchandise revenue once was. Even athletes who participated every season during that 4-year span could earn only a few $1,000s total from licensing distributions. For a professional sports league, such figures reflected a market still developing its commercial footprint. Merchandise existed, but it wasn't moving at the scale seen in more established leagues. Fast forward to the 2020 to 2025 licensing cycle and the contrast becomes striking. The union announced that it will distribute approximately $9.25 million generated from licensing over those 6 years. Players who are active throughout the entire period are eligible for maximum payouts around $50,000. That leap isn't incremental, it represents exponential growth. Economically, it signals that demand for league-branded products has expanded far beyond its previous baseline. Merchandise revenue is often considered a strong indicator of fan engagement because it reflects voluntary spending tied directly to enthusiasm. People don't buy jerseys or collectibles unless they feel a connection to teams or players. When licensing income rises sharply, it usually means the audience isn't just watching, it's investing emotionally and financially. For leagues, that kind of engagement can be more valuable than short-term spikes in ratings because it suggests sustained interest. Analysts sometimes describe such jumps as inflection points, moments when growth accelerates after years of gradual progress. A 3,000% increase over 6 years fits that description. It suggests that something shifted not only in visibility but in consumer behavior. Fans didn't just start paying attention, they started purchasing. For players, the difference is tangible. Licensing payouts represent money tied directly to their likenesses and performances. Larger distributions therefore feel like direct recognition of their marketability. For league executives, rising licensing revenue validates marketing strategies and brand building efforts. For sponsors, it signals a vibrant marketplace worth investing in. Taken together, the licensing surge reinforces the broader narrative surrounding the 2025 season. The business side of the league is evolving rapidly. And when merchandise sales, attendance, and broadcast interest all rise at once, it creates a financial environment capable of supporting milestones that once seemed far out of reach.
Brianna Turner puts out her chest and says, "This shows our value and how what we're fighting for makes sense and how we should keep fighting." Well, why was there none in 2022? There was none in 2023 or 4. You better thank a certain somebody who you played with last year. You better thank a certain somebody who you played with last year.
Stimulus package might sound like exaggeration or headline drama, but in this case it reflects what many analysts describe as the genuine economic significance of what just unfolded inside the WNBA. For the first time in the league's nearly 3-decade existence, it generated enough qualifying revenue in a single season to activate its player revenue sharing system. That milestone alone marks a historic turning point. Approximately $8 million is now scheduled to be distributed across team rosters, and insiders across front offices, agencies, and player circles all understand that such a moment didn't materialize randomly or overnight. It represents a convergence of timing, visibility, marketing traction, and fan engagement reaching a level the league had never before documented. What makes this development especially noteworthy is how long observers wondered whether this clause would ever actually be triggered. When the revenue-sharing mechanism was first negotiated, some analysts quietly suspected it might remain more symbolic than practical, something included in the agreement as a sign of good faith rather than a realistic expectation. The league had experienced growth phases before, but none had pushed financial performance across the threshold required to release shared earnings. That changed in 2025, when ticket demand, broadcast interest, and merchandise activity collectively surged in ways executives themselves had not publicly forecast. The phrase "everyone knows who made it possible" has circulated frequently in commentary surrounding the announcement. While league officials have credited multiple factors, expanded media partnerships, increased marketing efforts, and broader cultural interest, fans and commentators have focused on a single central catalyst: the arrival of Caitlin Clark as a professional star attraction. Her transition from collegiate sensation to pro headline name coincided with record attention metrics across several categories. Arenas that once struggled to fill lower bowls suddenly reported sellout crowds. Secondary ticket markets reflected surging resale demand. Social engagement numbers climbed dramatically. Even casual viewers who had never previously followed women's basketball began tuning in to see what the excitement was about. Financially, that surge translated into measurable outcomes. Sponsorship visibility increased. Merchandise moved faster. Broadcast partners saw stronger viewership spikes during games featuring her team. All of those elements feed into league revenue calculations, which in turn determine whether contractual benchmarks are reached. When those benchmarks were finally crossed, the revenue sharing trigger activated automatically according to the agreement's formula. So while the payout figure itself is substantial, the symbolic meaning may be even bigger. It signals that the league has entered a new economic phase, one where growth is no longer theoretical or projected but demonstrable and quantifiable. After 29 seasons of incremental progress, the system designed to reward collective success has finally been put into action, marking a moment many within the sport view as proof that its long-anticipated breakout era may have truly arrived.
Of shared revenue amounted to about $16 million, according to the union. Of that, $8 million will be paid to players who were active in 2025, the union has said. As mandated by the CBA, the other half will be allocated to league marketing agreements, which are off-season initiatives offered to some players to promote the league and its partners. Union leaders also said on Sunday that they will be divvying up $9.25 million to players from licensing revenue generated since 2020 from jersey sales, trading cards, video games, and other merchandise. The union expects to share that money.
Although both league officials and union representatives confirmed that the revenue-sharing mechanism was triggered, neither side publicly disclosed the precise financial threshold required to activate it. They cited confidentiality provisions written directly into the collective bargaining agreement. Even without that exact figure, however, certain details allow analysts to estimate the broader financial picture. According to union disclosures, the players' portion of shared revenue for 2025 totaled about $16 million. By contractual design, that figure represents 50% of the qualifying amount after 30% has already been deducted for expenses. Half of that $16 million, roughly $8 million, is being distributed directly among active players from the season. The remaining half is earmarked for league-related marketing partnerships and off-season promotional programs intended to expand visibility and brand reach. That structure reflects a negotiated balance. Players receive immediate compensation while also investing part of the shared pool back into initiatives designed to generate future revenue growth. Economically, it's a hybrid model combining reward with reinvestment. What stands out to financial observers is that such a payout doesn't occur by coincidence. Revenue sharing is triggered only when multiple income streams rise simultaneously. Attendance is often the most visible indicator. Reports indicated that crowd numbers increased substantially during the season, particularly for matchups involving high-interest teams. Strong attendance doesn't just affect ticket sales, it boosts concession revenue, merchandise purchases, parking income, and local sponsorship value. Each sold-out arena contributes layers of financial activity beyond the gate itself. Television viewership and digital streaming metrics also play a crucial role. Broadcast partners evaluate ratings carefully when determining advertising rates and future contract terms. When games attract larger audiences, networks can justify higher ad prices, which ultimately feeds back into league revenue totals. Similarly, merchandise sales, from jerseys to collectibles, add another dimension. When a player or team captures public imagination, licensed products often move quickly, creating additional income streams counted in revenue calculations. Taken together, those factors illustrate why the 2025 season stands out. It wasn't one metric rising slightly, it was several metrics rising sharply at once. That convergence is precisely what revenue-sharing formulas are designed to capture. The mechanism activates only when overall business performance crosses a defined line. When that line is crossed, the payout becomes automatic, not discretionary. So while the exact threshold remains undisclosed, the available numbers tell a clear story. The league generated enough surplus revenue after expenses to unlock a distribution larger than any in its history. For players, that represents validation that growth is translating into tangible financial benefit. For executives, it demonstrates that investments in promotion and expansion can yield measurable returns. And for analysts, it offers rare insight into how modern sports leagues structure incentive systems linking performance, popularity, and profit.